Richard. And here they go. What time is it? We still have 2 minutes. So Olivia, is there any way that anybody can say hello, or is that too complicated for our first go around?
I think for right now, if everyone just stays on mute, if you have questions or anything, you're more than welcome to put them in the chat. And we will try to get to them either during the course of the presentation or at the end, and any that aren't answered, I will of course forward to my mom. But it should be good. But for now, I think if everyone just stays muted, we can get the presentation started in a minute.
Okay. There's just a part of me that wants to chat with people. But we are going to get, or I am going to get, thankfully Olivia is here to help me with this first one. And the other ones coming up are involving the processors, and they are more experienced with it. But I think I'm going to get very creative with Zoom and how I can use this for small group settings, processor specific type meetings. It's just a matter of figuring out all the logistics, which I am pretty much behind the 8 ball on this, but better late than never. And I'm just chit-chatting now, just while everybody's still coming into the room. But I think earlier on in the pandemic, and yes, I had some schools scheduled. There was the one in Miami Beach, one in Honolulu, one in Palm Springs. And yeah, earlier in the year, I'm thinking, oh, it'll be fine. You know, we'll still be able to make the June session or the August, and, you know, month by month, and just, so. Da, 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 da. It's 1 o'clock. I'm just going to move. I'll give you a good idea of what this presentation is going to be like. Not the presentation, the content. And we'll get there in a minute. It is not all doom and gloom, but it is going to be a bit challenging in the credit card arena for the remainder of this year and even into 2021. So let's just continue to let people in. We'll give it a few more minutes. I see someone. Can everyone hear me? If you can't hear me, Olivia is here with me. She's my daughter, and she's going to be handling the technical. Again, this is my first Zoom. I don't have a whole lot of idea what I'm doing here. I'm a newbie. So Olivia's here to help out. And I would like to share, and we're just going to get started in a moment. Many of you have been to my schools. And prior to Olivia starting law school, she used to help me at my schools. And the last 3 years, she's been at Northwestern Law School. And we are sitting here practicing for the webinar today, not less than an hour and a half ago. And she got notification that she passed the bar. First try, and now she is officially, you're an Esquire, Olivia? So my daughter is an Esquire. So that's all very, very exciting. So why don't we, it's 1:03. What do you think, Olivia?
Get started.
Get started? All right. I first want to say to everybody, thank you again. It's good to be back even in this virtual world. I basically have been MIA for 7 or 8 months and just took a break. And to be honest, in the beginning, when we didn't think this pandemic was going to last, I didn't know what to tell you guys. I didn't know you had your own things to worry about. And now I finally feel I've been doing a lot of research, catching up on things, and now I feel I'm in a position to offer you some good sound advice. The reason I am doing these 6 webinars for free in the month of December, it's just my way of giving back to everybody. You have been very supportive to me over 17 years. And so through the help of my processors, or my sponsors, what we're going to be doing over the next few weeks is cover many of the highlights of how to be managing specific things during COVID when it comes to your card programs. What I hope to do is, hold on. There we go. What I hope to do in January is do this on a more regular basis and actually even do weekly chats and really use Zoom to stay connected with everybody on a much more frequent level. So with that, hold on, I'm getting the technical thing here. What we're going to be reviewing today is some portfolio management highlights, the changes in consumer spending, how to manage profitability during COVID, and then some short-term strategies, what you should and should not be doing. And it's going to be a little interesting. Card programs, I hate to tell you this. Oh, let me just back up here. You can screenshot this, do what you need to do, but these are the sessions coming up in December. They're every Tuesday, Thursday. We're covering rewards, risk, revenue, digital strategy options, and then items with MasterCard. So let's go through some of the portfolio management highlights. Credit cards, and a lot of my information that I've been researching, it's going to be at the end of the presentation. I get my research from TransUnion, Mercator, Experian, a whole host of places. And basically, credit card balances have decreased significantly on both a quarterly and annual basis. They've declined across all credit tiers. The average, not average balance, but aggregate consumer balances are also down. And overall, when we look at the entire industry, I mean, the banks included, their outstandings are down 10%, and that's the lowest level they have been since Q2 of 2017. So it's not good. It's not looking real good here. What I want to show you here, and this is also from Experian. If you look at this chart on the left side, you see the year, and then we see the balances in each column by quarter. And typically balances with card programs do increase Q3 and Q4, but look what's happening in 2020. We've gone from 738 billion down to 723 billion. And that is when card balances typically start picking up. And then Q4, we don't know where we're going to end. Now that is nationally, all bank cards. What I've done here is I've taken the information from NCUA to kind of see where credit unions are falling in. And again, for those of you that are regulars at my school, I always track assets, loans, card loans, and the infamous card loan to total loan ratio. For those of you on the phone that do not know, or on the call that do not know what the card loan to total loan ratio is, it's a ratio is to measure the size of your card program. Ideally, you want 10% of your total loans to be card loans. So nationally, as you can see, back in December 2018 on the far right side was 6.3%, June of 2019, 6.2, December 2019, 6.3, and June 2020, it's down 5.7. What I do want to show you is between December 2019 and June 2020, look at assets. Those are increasing tremendously. We all know that. You're getting deposits like crazy. Loans are also increasing. Look at cards. Cards have gone from 66 billion down to 60.9. And I wish this information would have been available through September, but on NCUA, it was only available through June as of last week. So the year-over-year change from June 2019 to June 2020, card loans are down 2.4%. That's not good. From December 2019 to June 2020, we're down 7.7%. So if you are not growing, you are not alone. And you're going to be very surprised what I suggest as we get further into the presentation. Now, we've heard and we've seen, we've all seen that, oh my gosh, credit scores are at an all-time high. I don't believe that. I think they are artificially inflated because of all of the programs that have been put into place to help businesses and individuals with unemployment during COVID. The delinquencies and charge-offs that you're seeing are artificially low right now, so don't get too comfortable. The delinquencies will rise in the coming months because all the programs are running out, and the latest I heard that it's still stalling in Washington whether there will be another stimulus package. And then the charge-offs, and don't freak out, but yeah, charge-offs are expected to double nationally up to 8% for banks, which in our world will mean our charge-offs are expected to go up to 4%. So when we get into the managing the expenses, please know charge-offs are typically the top expense of running a card program. The top two expenses are charge-offs followed by card processing. So you can bet charge-offs are just going to be off the charts. And then we're going to have, I'm getting ahead of myself, but we're going to have to kind of make amends for that. So this is where I'm going to kind of, this is very unlike me, and feel free again to take screenshots. Don't be doing new acquisitions at this time. Do not be adding to your credit card portfolio at the current time. This is not the time to be doing acquisition, trying to get new accounts, anything like that. I know you've got money to lend, but credit cards is not the place to be lending it, especially with these artificially inflated credit scores. You need to review, as I'm sure you've already done for other products, your underwriting standards. Don't be doing credit line increases. This is not the time to be doing credit line increases. Just halt, put a halt to everything. And then one thing that I read that was really interesting is in one of the studies is to decrease credit limits across the accounts that have low utilization. So for those of you who don't know what low utilization is, it would be those that are less than 20%. Let's say somebody has a $10,000 credit line and their balance is $2,000. That's a low utilization. Olivia, are there any questions coming up? I can't hear you.
I forgot I was muted for a second. Forgive me. I have not seen any questions coming up, but guys, if you do have a question, feel free to put it in the chat, and I will kindly interrupt my mother and ask it.
Thank you, sweetie.
Okay, on that note, Mom, there is a question that came up. The question is, when we lower the lines, do we need to process an adverse action?
Yes. If you lower the credit line, you do have to notify the cardholder. And we can get you more details. And Olivia, are these questions being checked or tracked on Zoom somehow that we can print them?
That transcript will be saved so I can pull them out later. And if you want to send answers in written form to the group, I can help you arrange that. That
would be great. If I know these questions are on the transcript. All right. So your overall profitability is going to be down for cards. Your balances are down, and as many of you know, the majority of card program revenue, 70% of it comes from finance charge income. The lower cardholder spending is going to hit your revenue. There's been a marked decline in POS transaction volumes, and the hardship programs related to rate reductions and fee reversals. So many of you are probably refunding fees or reducing rates and helping members get through. So there is light at the end of the tunnel. This is what you should not be doing right now. Do not be doing 0% balance transfer offers or any of these unlimited introductory offers. The reason I am saying this, and it's not to say that you cannot do this when we get back to some sense of normality, but we already know that charge-offs are going to double. Your expenses are increasing. Your interchange and likely finance charge income is going to be down because balances are down. So don't add to the problem by doing the 0% or these unlimited introductory special rate offers. The average credit card rate right now, according to creditcards.com, this is for a credit, and it's a variable rate, is just over 16%. So I can guarantee that almost every credit union on this call, your program rate starts in the 8 to 9% range. So you're already beating the banks, and we just need to kind of pull back a little bit on these 0% and balance transfer programs.
So Mom, there was another question about lowering credit limit and whether it will adversely affect the member's credit score because the credit line usage will increase.
Yes, yes, it will. And that is something, if you know me, I've not been somebody in the past to recommend or suggest lowering credit lines, because you're basically going to tick your member off. But when we look at the whole picture and the risk that perhaps the credit union is taking, and we don't know where your profitability is at this point, only possibly consider lowering the credit line as a last resort. It's not something that I would highly suggest, oh yeah, go lower credit lines, because I think that's a really honestly bad move, but we've never been in these waters before. And I think I will have to, I'm gonna make a note, I'm gonna do more research, and maybe we could have a little credit union Zoom chat about lowering credit line increases and the steps needed to do this. Let me make a note here. All right. So moving on, the consumer spending changes, what's going on here? And this is from, where did I get this information from? Oh no, I'm not there yet. So obviously the pandemic has changed consumer behaviors. They're cutting down on discretionary spending. They're saving more, as you can see that on your balance sheets. They tend to be aggregating purchases with merchants who either have a digital presence, the home, excuse me, the delivery and drive-through pickup options. And in the beginning, we saw a lot of canceling transactions, I myself included, travel, sporting, entertainment. I had to cancel my hotels in Hawaii for the meeting, in Miami for the meeting, in Palm Springs for the meeting. I didn't get any refund, which really kind of stinks, but that is basically going to be raising your chargeback volume. So you're going to see that expense increase with your processor. Let me go on here. My throat's getting dry, so hold on. This is my favorite chart. And unfortunately, what I want to look at is blocked out by the little camera thing. So hold on a minute. Let me go through here and get the right chart. So I found this very, very interesting. And this was actually, I think this one is from TransUnion. I've got the resource in the back. So I didn't go to any specific processor to get this. I just went straight to an independent organization. But travel is down 27%. Furnishings are down 15%. Apparel and footwear down 9%, electronics 9%, fuel and gas 6%. And obviously what's increasing is groceries, household goods, utilities, medicines. Yeah, imagine that, people needing medicine during this time. And then home internet and phone for small businesses. The reason I put this chart up is the whole theme of my session here is you're going to have a hell of a time building balances in 2020 and maybe early into 2021. It's just, in my professional opinion and experience, it's not going to happen. What you do need to focus on, though, is usage. And this particular slide is very pertinent information, especially for those of you that have reward programs, to be offering, again, to make your card the primary card. It's the groceries, household goods, utilities, medicines, home internet, phone. Start offering 3, 4, 5 times the points. I'm not going to spend too much time on that. Our call on Thursday with Razor is about loyalty and the programs, but get in your mind, forget about building balances this time, and we're going to focus on usage and adapting to the new consumer behavior and what your members will get the most out of your card. This is the fancy chart of what I just showed. This is where it came from, Deloitte. And I thought it was a pretty chart. I simplified it by putting it in that table, but here is the official information from Deloitte. So usage again versus acquisition. This is where you can use your processor to help you get this information. They are able to get, no matter who you process with, the transaction volumes by merchant, what the categories are, and get the trends by debit and credit, and then create the usage campaigns around that. That is the only marketing you should be doing right now, is usage. This is so weird talking one way. I'm used to being at a school where people talk back and everything else. So, but I hope you're enjoying it. So we're going to move on to managing profitability. And this is going to be a review for some of you. But no matter what happens, when we talk about profitability and your analysis, to really get a full picture of your card program, you need to be doing the analysis, reviewing the income, and reviewing the expenses. This is a reminder, maybe new for some of you, but the annual net income for your credit card program per total account on file should be at least $75. The good news is, in all of the years I've been doing this and working and doing the schools and working with clients of all sizes, that number is typically anywhere from 150, 200, 300. So from the outside looking in, there's a lot of padding there, and most of you still have profitable programs, and I bet you still will continue to have them unless you are doing those 0% offers. I don't think anybody's card program is going to go under or really suffer. You just have to be able to manage all the different portions of it. So we want the $75 in annual net income per account for all of those of you that have been to my schools. I give you the data sheets. This is the time to use them to see how the pandemic has affected your portfolio specifically in all of these areas. Now, the one thing that will not change during this pandemic is the credit union card profitability model. The finance charge income, the way the revenue is typically split out, is 70% finance charge, 15% interchange, and 15% fees. It still should be those ratios, but expect to see much smaller amounts in all categories. So when you start going through your own analysis. Now the interchange income, The interchange of your card program typically should be 1.68 to 1.76 of net sales. And this should also shrink just because of the change in the way consumers are spending. I mean, I, for one, my annual business expense to United Airlines was around 20 to 25,000 a year. This year it's zero. So I probably am not necessarily generating a lot of interchange for my card issuer. But that the interchange is going to be shrinking based on the type of transactions that are happening. And the transactions that are happening are not the big ticket items. They're groceries, they're pharmacy, everything that I showed you before. So what I suggest everybody do is calculate your effective interchange rate month by month, all of 2020, and do it on a spreadsheet. And the way you would do this is create a spreadsheet. You want to identify your net sales for that particular month and the interchange that you received for that particular month, and then divide it into each other, and you should get your effective interchange rate. And then to see if that has fluctuated, even I would go back even to last September, you know, Q3 of 2019. And I don't expect to see huge shifts, you know, from 1.76, but I do expect it to be down a little bit. And that will give you a good clue as to, you know, rather than the dollar amount of interchange that we're getting, is the rate changing. If you're down in the 1.5 range, then you may want to start worrying and perhaps call me, and we'll see if we can figure it out together. So your fee income, this is the other thing, and I feel like I'm just a bunch of bad news, but it's just the reality right now. Your fee income will also be down because you're probably waiving late fees, you're forgiving late fees, and this is the perfect time to do a late fee income audit. And many credit unions find missing fee in this way, and it's very simple. You want to ensure that your minimum payment, and keep in mind, I've got so much to share with you guys, and this is like a quick overview, and I'll do more specific, more detailed sessions in the future, like quick half hour just on fee income or just on decreasing credit lines. But you need to do a late fee income audit. Many credit unions, for example, and I'll make this very quick, if your minimum payment is $20, but your late payment is $25, you're only collecting $20, because the Card Act does not allow you to collect more than what the minimum payment is. And I know from my schools, there's at least 30% of all credit unions that run into this. You also may want to rethink the number of grace days. If you are one of those kind credit unions that offer a 10, I've seen 20, and even 30-day grace period because you want it to match up with other consumer loans, because of the losses that you're going to have, sorry, but it's the truth, you need to make up for that. So I don't want some CFO, all due respect, sirs and women out there, saying we need to increase fees, we need to do this. No, you don't. If you're at 10 days, reduce your grace period to 5 days. If you're at 5 days, maybe now is the time to go to 3 days. And I know there are some credit unions that have 1 day. There are other ways to be offsetting some of the expenses come in. And do not, this is Ondine saying herself, do not increase or add any fees just to try and make things up on the other end. There are other more creative ways to do it. This is, feel free to take a screenshot or a picture of this if this is the first time you're hearing about making sure the min pay equals the late pay. The grace period, again, I mentioned this. This is another way you can increase your fee income without affecting your member. And here we go, the expense management. This is going to be where the other side of helping your profitability. Charge-offs will be your largest expense in 2021. We're expecting it to be up to 4%, and your expenses will be increasing overall as your income is decreasing. The top program expenses, and this goes back years and years, 60% of the card program expenses, number 1 and 2 are processing and charge-offs, and they typically go back and forth between number 1, number 2, depending on how willing to take risk the credit union is. The second next highest expense is reward redemptions. So I expect many of you to see your processing expenses to go up as well, and we'll go through that in a moment. This is going to stay the same, and I'm standing firm with this. If you are an average size credit union, your annual processing expense per account on file should be $35, $30 to $35. If you are a $1 billion credit union, expect it to be $20. If you are a credit union that has multiple relationships with that processor, with core and credit and debit, you should maybe be in the $25 range. If you're in-house, it should be less than $10 annually, but that's a little deceiving because you've got a lot of add-on services. But the reason I'm saying, and I'm introducing all of these things back to you, is because the card programs are not growing and you're not using your resources, or I'm going to suggest you not use your resources to grow the program. This is the time to be doing the other things behind the scenes. Now, with the processor invoice review, here's another to-do, is get your latest processor invoice. We are in December now. Get the November one and put it on a spreadsheet. It's what I do all the time. Most of the processors have it by category, and just compare November 2020 to November 2019 in a side-by-side column. You will see increased processor expenses, and it will be related to chargebacks, fraud management, implementation of contactless mobile wallets and mobile payments. And this is the time to cut non-essential services from your card processor invoice. And yes, they're going to hate me for saying this. Sorry, don't care. I say it the way it is. If you're paying tens of thousands a year for portfolio advisory services or marketing recommendations or marketing campaigns, I hate to say you may not be able to afford it, but until we know if your account is making $75 in annual net income and your expenses are increasing and your income is decreasing, it may come time to cut some of the non-essential services from your processor invoice.
So Mom, there was a question on this topic that if you're in-house servicing, how do you calculate some of these expenses?
For in-house processing, the $10 I showed is strictly processing. It does not include statements, postage, chargeback, cardholder service. I have a whole sheet specific for pass-through of all the expenses that should be included, but all of those included together should still be $30 to $35. There is an assumption that pass-through in-house is cheaper, and it's not. The processing invoice is, but when you add on all of the other services, it ends up being the same. Okay, I'm gonna ask a question, and Olivia, get these responses. Will you guys respond if you're liking this or not? Just yes or no. Is this helpful? Yes or no? Because I haven't been back to work since February, and I just want to make sure that I can't hear you, Olivia. Olivia, I can't hear you.
I cannot keep up with how many yeses are, and very helpful. Love it. Definitely. This is great. One request to slow down a bit so people have a chance to screenshot. We also had a request if you're going to be sending out the slides, and I wasn't sure if you had decided, so I'm not sure, just throwing it out there. But everybody is enthusiastically in support of this information that you are sharing.
Awesome. Thank you so much. I just want to make sure because I'm not getting that feedback face to face. Okay, hold on. Yeah, let me just touch on something quickly because there's a reason I'm doing all of this for free in December is to test it, see if you guys like it. And I'll tell you what the ultimate plan is starting in January for 6 months, because I'm hoping by next fall we can travel again. But at least for 6 months, I'm going to be doing all of these types of things. And I would like to do them on a weekly basis, even just mini chats or mini sessions. And still, I've got to make some money. I haven't made money all year. And then charge a small fee for a 6-month subscription. So that's kind of where I'm going with this idea, because my income dropped off dramatically back in February. I mean, from it just nosedived. So I do have to start making money again. And I figured I haven't made money all year. Why start making some now? I'll have a good tax return this year. So anyway, that's my plan. So if you guys,
So Mom, just a heads up, you just have 10 minutes. You have 10 minutes left in your timing, just as a heads up as to where you're at.
You're a sweetie, thank you. And I am almost done, and that's why I was just sharing that information. All right. It's my Esquire daughter there. For those of you who joined late, and I'm just going to say this, we were rehearsing or not rehearsing, but working on the setup of the call to make sure that everything was going to go off good for my first Zoom. And she got notified on her phone that she passed the bar exam. And Olivia had gone to Northwestern Law School. She graduated in May. And so we were very, very excited. And all of this just happened this morning. So anyway, enough of that. So let's go back. I want to give you reminders. Screenshot this too, of income and expense. These are key numbers. When you're talking about setting goals for your card programs, do not focus on penetration in the number of cards. You want to focus on percentage of total loans, 10 to 15%. It would be interesting to see what your card loan ratio is now. The more successful programs tend to be in the 10 to 15% range. The national average, as we saw, was just over 6%. But not that it means anything in 2020, but it will as we go forward in 2021. Your income allocations, this is a summary of how those should be. Your interchange, 1.67 to 1.72 of net sales. Your processing expense, $30 to $35. The annual net income per total account on file should be at least $75. And those who know me have always said you should always offer at least one fixed rate option, non-variable. And how sweet would that be right now? So if you don't offer them, I still want to encourage you to think of a fixed rate. We're going to have a whole session on that too. Short-term management strategies. And if you've been watching the Queen's Gambit, that's where I got the idea for the chess set. So marketing in the short term, do not do any acquisition, do not do any line increases. You're just increasing your exposure. The marketing.
Hey Mom, before you keep, sorry to interrupt, but before you keep going on to a new topic, there was a quick question. If you could elaborate on why you recommend the fixed rate before you switch gears into marketing.
I may not have enough time, but let me put it in a nutshell. And I'm certainly willing to have this conversation at a later time. Over my years in doing the school, what I find, I always survey the classes, how many of you risk-based price your portfolio? And of course, everybody raises their hand. And then I say, and when was the last time you actually scored your portfolio? And people are looking, never. So the whole point of a fixed rate program, consumers prefer a fixed rate. They want to know that's what they are going to get. It's not going to change unless they mess up. If it's the rate change due to the economy and nothing they ever did, they typically will get ticked off about that. But there's so much more to go into it, and I will, when we have more time, we have a survey at the end of this to see what sessions you want to see coming up. It is a very lengthy discussion, but it's also very simple. You have a fixed rate to drive balances. You have a variable rate for the spenders and transactors. The most important thing is, with fixed rate programs, going back to the way it used to be, we used to score cardholders at reissue. There is a reason for an expiration date. If your score has changed during the 2 or 3 year time period, then guess what? We're going to change your rate because you've mishandled your credit. People will say, well, the Card Act doesn't allow it. Yes, the Card Act does allow it. So I will go into further detail, whoever it is. If you want to email me, we can have that conversation, or we can do a webcast about it. So let's, okay, halt acquisition, halt line increases, focus on usage, accelerate the shift to contactless payments. Now, what's coming up, I think next Tuesday, with Dr. Art from PSCU, who's been at all my schools, he's going to put together an entire contactless mobile payment strategy that credit unions can use no matter what your processor is. I invited him because he's very good and experienced in it. I don't even know a whole lot about it myself. That's why I bring in the experts. Usage, rewarding in a new era. Again, focus on categories which rely on staying connected, dining at home, working and running a business remotely. We've got supermarkets, home improvement, everything that I mentioned on that previous slide. This is more for the CFOs and people who are so quick to say, well, we're going to do it because Bank of America does it or Chase does it. Don't do anything because the banks do it. If you look at our profitability model on this chart and our portions of revenue compared to the banks, it is very, very different. We are credit unions. We are built on loans. That's why finance charge is so much more important to us. So don't start charging cash advance fees, balance transfer fees. You better not be charging a penalty rate. All APRs should be less than 18%. And you can see everything here. There are other ways to increase profitability without, dinging the member and nickel and diming the member. So things to focus on right now. These are, quote, little projects you can be doing, is make sure you've got your contactless and digital strategies. You can join the webcast next week. Do your income audits, interchange, late fee, review your grace period on late payments, and ensure all your fee income is being collected. You'd be surprised when I do my schools, and a lot of the processors that are now using First Data, which includes Co-op, PSCU, and Fiserv, there's a parameter for return check fees that, quote, needs to be turned on to automate it. You'd be surprised what is listed on your disclosure is not necessarily what's in the system. So this is just another portion to consider. Regarding expense control, start a spreadsheet and start tracking your expenses. Get the invoice out, and yes, some of them are maybe 15 pages long, but they are so simple to put onto a spreadsheet by category to see which category is increasing or decreasing, then you know what to tackle within it. This other one coming up is track and analyze loyalty program usage, redemptions, and update the earning categories. And we'll discuss that more on Thursday with Sarah from Razor. But if you're still offering travel on your reward programs and you don't have the ability to update it to make it more like Home Depot, Lowe's, Menards, the grocery stores, then there's a problem there. I don't want to get too far into this now, but now is a really good time to review and audit your reissue criteria, not only for credit, but debit. Excuse me, I need some water. Because we are coming out of the pandemic and you may have a reissue coming up, some of the reissue criteria I've seen from credit unions is what was originally put into place when the program was set up, where you review the delinquency, credit scores, usage. You don't want to be reissuing to inactive cards, accounts that had never been activated. And it's not something the processors really highlight that you do, but you need to get together and review and audit your reissue criteria. Do not waste your money or time on acquisition campaigns, credit line increases, and do not be adding new fees at the current time. Here's the special project for the reissue criteria, and I think I'm running short on time, so just take a quick picture of this. And maybe we'll do a special like 30-minute reissue call with the new online school. Could be more fun. We could get together more often. I put this in the presentation. Please snapshot this. This is how your program should measure up. Everything's still in flux, and until I see some year-end 2020 numbers, which won't be until early 2021, this is where things should be on a regular basis. The only thing I truly see decreasing would be the average balance for accounts with balances. That's maybe 2, 4, 6 lines down. And we're going to temporarily see the charge-off ratio increase, and probably the 60-day delinquency. But this is a starting point of where we were. Where we're going to be in 6 months, if anybody says they can tell you, I doubt it. So I don't like making promises that I don't know anything about. Excuse me. Now, for everybody who's into research, I can continue to do the research and share it with you on these webcasts. But these are the resources I used for the information in this webcast. I used some from Deloitte, Mercator, Experian, TransUnion, JD Power, creditcards.com, The Points Guy, payments.com, Payment Journal, NCUA, and of course my own experience. So I know that might have been really, really quick. I was unsure if I had too much. I guess I'll get better with the timing. But if there's any questions, because what time is it? It's 1:46. Any questions come? Oh, let's do the polls. Wait, before everybody hangs up, let's do the polls. I've got some polls about how we can do this in the future. So the future sessions in progress, mark what you would like to really have like specific sessions on. Because any topic that I've gone through today, we could spend an hour on it. Because keep in mind, when I do my schools are 2.5 days, which is 8, 16, 20 hours of education. So
I also just like to point out that those of you that messaged specific content ideas that might not appear on this poll will get back to Ondine. So you don't have to worry about that there's not a comment section. Those have been noted. And there are 2 polls. So if you have 1 extra minute when this one is done, we're about 65% voted on this one. I'll launch another one just as a heads up if you have time for another quick poll.
And because I would love to do this. This is good for my mental health as well. Getting back to work, and I love doing this, and I would really like to continue, but I want to make it specific. And I mean, I was thinking all kinds of things, like, for example, imagine if I had a big meeting and then I had all of the PSCU clients in one meeting room. And then I guess we can do breakout rooms and things like this. I'm learning all this stuff about Zoom, and how fun would that be? Or if you guys have experienced any formats that you like. I just chose Zoom because it was on GoDaddy and that's where my website is. If there's a better, what you might feel is a better software to be using. Why is portfolio analysis red? That went red. And then this is just because I just wanted the feedback to know if you were getting, I know it was quick. There will be more. There will be more. And I think I will send out to everybody who has a credit union email address. I know we've got some processors in here as well and some sponsors. I will send this out to everybody. Not the recording. I think the PowerPoint is more accurate. In the future, let me tell you what I'm going to be doing. I'm going to be taking these recordings and I have set up a Facebook page and there's a private area for quote members only. So every time I do a education session, I am going to upload it to the private page on the GoCUCards YouTube channel. And I think there are some that I'll be able to make even without an audience, you know, just make some training videos and put them out there. But then that's it. But I'm going to end, and I want to thank everybody so much. Heartfelt thanks for your support, making this so successful. I was humbled when I saw all of the registrations come in, and I love this industry. I love all of you guys, and it's just been really, really good. And just bear with me while I get it all together, because I think things are going to get real busy real soon. So with that, I'm going to say goodbye. Thank you. And thanks to Olivia, my daughter, for helping me with this first one. And you guys are great. So thanks so much.
Thanks, guys.
See you later.
Thank you. It was great seeing you again.
Who was that?
This is Sally at launch.
Oh, Sally, hi.
How are you?
I'm good. It's so nice to hear a voice.
Yeah, I was very excited when you sent these out.
Oh, thank you. Thank you. Thank you. So Olivia,
Mom, sorry, to answer your question about why portfolio analysis went red, that was because that got the highest number of votes. So by the time I ended the poll, 61 people had voted. Thanks, Matthew. Thanks, guys.
So are we still on?
Yes, would you like me to end it? I just didn't, I thought people might want to say a
Oh,
farewell
if
before they
anybody
left. I was
wants to
waiting
say
for
hello,
everybody.
I'd love to.
I was just waiting for people to leave, fill out the chat, so I didn't cut that off in case, you know.
Norma is here and Mike at Sandia is here. Kyle, Rudy.
Everyone's, I think, just filtering out. Okay. I'm going to end it now. I feel like everyone's had their chance. I'll see you in the other room, Mom.
Thanks, sweetie.